Hello, and welcome to Signals and Noise, where strategists and economists from around the globe offer a shorter take on markets and economic matters as part of global research here at BofA. I am Benjamin Bowler, head of global equity derivatives research, and I'm joined today by my colleague Arjun Goyal, and we're recording this episode on Thursday, July 23rd. Are we in an AI bubble? I think this is the number one question in markets today, and the answer to this question has profound implications, not just for investors, but for the global economy, and I would argue even geopolitics. And it's a question that we have spent the better part of the last several years trying to answer. The short answer is yes, we are seeing a strong rise in bubble behavior across markets. But no, we don't see signs of the AI bubble near its end. So, look, as derivative strategists, we think about markets through the lens of volatility and risk. So, what does this have to do with asset bubbles? You might be asking. Well, it turns out that one of the most telling markers of historic bubbles is risk or volatility rising as asset prices go up. In fact, we have seen the same pattern of markets becoming increasingly unstable in nearly all major asset bubbles in the last 100 years. This includes in US equities in the roaring 20s, the famous Japanese equity bubble in the 1980s, and even in the Bitcoin ICO craze in 2017. But I think the reason we argue a bubble from AI is likely inevitable is that if you look back across the last 200 years, big tech leaps almost always lead to big asset bubbles. We saw this in railroad stocks in Britain during the first industrial revolution in the 19th century. During, again, the roaring 20s with the development of the automobile and electrification of the economy, and in the 1990s internet era. And the reason for this is that big tech leaps create a big fear of missing out among investors who want to own a part of this magical new future. But at the same time, the disruption from the technological transformation leads to a big rise in uncertainty around who will be the ultimate winners and losers and exactly when the magical new future will arrive. And it's this rise in uncertainty that has profound implications for not just the risk of markets, but importantly, their returns as well. And the reason for this is that this combination of the fear of missing out, or FOMO, plus the material rise in uncertainty causes markets to become more reflexive, meaning they start to infer fundamentals from price action. And I think we've all felt this, right? If you're very uncertain about the value of an asset, the fallback is to take signal from price action. In other words, when prices go up, you believe it's due to markets knowing more than you, and you update your valuation, and maybe you buy the asset as a result. But this creates a feedback loop, because as your buying pushes asset prices up, this causes others to update their valuations. So it's this circular feedback loop that creates momentum by construction and ultimately leads to excessive crowding, and eventually a violent reversal where asset prices become highly fragile as the bubble pops. So the rise of this dynamic is something that we termed the bubble era in our outlook last year, and it's increasingly a better descriptor of how asset prices are behaving than, say, fundamentals are. So how do we know this? Well, we created last year, again, a bubble risk indicator that has become increasingly valuable at spotting these boom-bust dynamics. So let me bring in Arjun, who has been one of the key architects of the bubble risk indicator, or BRI as we call it. Arjun, can you give us a quick rundown in simple terms of what the BRI is and how it works?
Yep, and thanks for having me on, Ben. So at a very basic level, the bubble risk indicator, or BRI, is a quantification of how bubble-like an asset's price action is. It's a normalized metric that ranges between 0 and 1, where readings close to 1 indicate that that specific asset is showing extreme bubble-like price action, while readings close to 0 indicate little to no bubble-like price action. The underlying philosophy that the BRI revolves around goes back to the observation you just mentioned earlier. Asset bubbles historically see volatility rising with price. As positioning and sentiment become increasingly stretched, day-to-day price instability also rises. The VRI aims to quantify an asset upside instability by using various price-based metrics to provide a single number indicating how bubble-like an asset behavior might be. Now, the beauty of the BRI's approach is that its computation only relies on price data. And so it can be computed on any asset with a sufficiently long daily price history. So this allows us to compute it on assets like gold or even crypto, where fundamentals and positioning data may not be as straightforward to procure or use.
Yeah, and I think what's interesting is this allows us, again, to look far back in time, as I mentioned, back 100 years, and across asset classes, from equities to commodities to crypto. And in all major historical asset bubbles, we've seen the BRI move towards its higher levels, 0.8 to 1, which gives us more confidence in its ability going forward. But we've also seen the BRI practically give us good information since we launched it last year. So can you explain some of the practical implications and successes we've seen of BRI in flagging this type of bubble risk?
Absolutely. Our analysis has shown that high BRI readings on assets typically imply increasing near-term tail risks in the forward distribution of those assets, both to the upside and to the downside. This is a long way of saying that if you see high BRI readings on an asset, expect further near-term instability and consider it a signpost of rising risk. As you mentioned, there have been numerous instances over the past 18 or so months where the BRI has been a very useful flag of such rising tail risks. So last year, subsequent to high BRI readings, we saw notable pullbacks in nuclear and quantum stocks. Earlier this year, and quite spectacularly, we saw parabolic rallies and crashes in gold and silver subsequent to high BRI readings. Korean equities, probably the poster child today of the AI story, has seen extreme BRI readings and experienced material pullbacks, but also parabolic rallies in 2026. And most recently, you have semis and memory stocks and momentum stocks in general having pulled back pretty sharply subsequent to high BRI readings.
Yeah, so definitely we're seeing, as I said, pockets of high BRI and instability and bubble-like behavior. But what is it saying today about sort of the question of the broader AI bubble?
In terms of the AI bubble at the broad market level in the US, BRI trends to us have suggested that we've moved more towards a bubble-like state as a market over the past 2 years, with US tech specifically getting pretty close to the upper echelon of BRI levels just prior to the most recent momentum unwind. But BRI levels are still yet to be, at the absolute extremes, especially with the recent retreat. And so it suggests that the potential for AI to grow into an even bigger bubble remains intact. Nonetheless, there are still some other pockets of the market, themes like cybersecurity or pharmaceutical stocks, that have high BRIs and continue to face the risk of further instability in the near term.
Yeah, so we've been getting a lot of traction among clients with the BRI. how are they using this tool, and how do you suggest people use this tool, in this bubble era environment as we're describing it?
Yes, we find the BRI very useful in today's environment, but what I will note is that given its purely price-based computation, we don't view it as a one-size-fits-all indicator that can completely replace more traditional fundamental and positioning-based frameworks. As a reminder, the BRI is a comment on the price, whether an asset's price action is bubble-like, not whether it is fundamentally overvalued. However, as you mentioned, in today's bubble era, where markets are showing increasing signs of being FOMO-driven and reflexive, the BRI has been an extremely useful tool to flag boom-bust dynamics and near-term risks. In fact, we find it better positioned as a risk metric than many fundamental ones in this environment, especially since in the past few weeks, we've seen that even fundamentally cheap equities, like many of those in the semis or memory space, can experience the boom-bust risks as suggested by high BRI readings.
Yeah, I think that's what's been most interesting, is that the BRI recently has been better able to foresee the magnitude of drawdowns in these broad risk-off environments than fundamentals like PE ratios. So to bring it all together, we see clear evidence markets are becoming more bubble-like, something we've been talking about since spring to summer 2024. But little evidence that we are near any type of ultimate top in the AI boom, and in part that's because we're not seeing BRI levels at the extremes we would expect from historical peaks and asset bubbles. But I think what we should expect is an environment of higher volatility, bigger drawdowns, but rapid snapbacks. These are all characteristics of bubble building environments like we see today, and I think we are expecting this going forward. The important takeaway in my mind is that to successfully navigate this environment, you essentially need to reframe your understanding of how markets operate. It's less about fundamentals and more about psychology. And our bubble risk indicator was designed expressly to monitor this increasingly important dynamic. Thanks for listening to Signals and Noise. We'll be back soon with more insights from BofA Global Research.
Bank of America and BofA Securities are the marketing names for the global banking businesses and global markets businesses, which includes BofA Global Research of Bank of America Corporation. Lending, derivatives, and other commercial banking activities are performed globally by banking affiliates of Bank of America Corporation, including Bank of America N.A., member FDIC. Securities, trading, research, strategic advisory, and other investment banking and markets activities are performed globally by affiliates of Bank of America Corporation, including in the United States BofA Securities Inc., a registered broker-dealer and member of FINRA and SIPC, and in other jurisdictions by locally registered entities. Copyright 2026 Bank of America Corporation, all rights reserved.